In this presentation, we're going to talk about three methods of inventory costing. They include absorption versus variable costing, joint product costing, and job order costing. Let's take a look at absorption costing versus variable costing. And in comparing the two, the question is, under which method, what costs are included in the product cost? In other words, what costs are included in inventory? And therefore, when that inventory is sold, what costs are included in cost of goods sold? So let's take a look at variable costing first, and let's consider what's included as inventory cost, part of the product cost. Under variable costing, the only thing that is included in inventory cost are variable production costs. All other costs associated with production in the company are considered period costs. So that includes any fixed production costs, any variable period cost, and any fixed period cost. Now let's take a look at what happens under absorption costing. What's included in the cost of inventory? And the answer is all of our variable production cost and all of our fixed production costs. What's included as period cost? That includes our variable period cost and our fixed period cost. Now, absorption costing is a traditional method of costing inventory, and this is the only acceptable method under generally accepted accounting principles. In other words, external financial reporting. Many times management will use a variable costing approach when they're producing their own, especially internal operating statements, because in many cases the behavior of variable costs versus fixed costs drive many of management decisions. Now let's go on and talk about, then this is typically where the CPA exam, the examiners like to ask questions. What is, depending upon whether we're doing absorption costing or variable costing, what is the inventory costing impact on operating income? So here's the rules that we need to follow. Okay, when production, in other words, production of inventory exceeds sales, that means the ending inventory is going to increase. And you think about that, that makes perfect sense. If we're producing more than we're selling, that means our ending inventory is going to increase. Now, because of that, that's going to have an impact on our net income. Under absorption costing, some of the fixed product costs are included in the ending inventory. Therefore, it's going to be have the net effect of reducing our cost of goods sold. Under variable costing, some of the fixed product costs are included directly in period expenses. Therefore, if we take a look at operating income is higher under absorption costing under these conditions. So when production exceeds sales, the ending inventory increases and operating income is higher under absorption costing. When production is less than sales, so we sell more than we produce, that means the ending inventory is going to decrease. Under absorption costing, some of the fixed product costs are included in the inventory. Therefore, that is going to have the effect of increasing cost of goods sold. Under variable costing, fixed product costs are included in the period expenses, and therefore the net impact is operating income is higher under variable costing. So when production is less than sales, operating income is higher under variable costing. And again, going back up to the top, when production exceeds sales, operating income is higher, but under absorption costing. Lastly, when production equals sales and there's no change in inventory, operating income will become the same under both absorption costing and variable costing. Now, we can look at this in a slightly different way because, again, many times on the CPA exam, you're going to be asked about when production changes versus sales and so forth, what's the impact on net income versus absorption or variable costing. So let's take a look at this next slide. Now let's take a look at absorption versus variable costing under taking a look at the financial statement of a company. We start out with revenue. We subtract our cost of goods sold. That equals our gross margin. We subtract out our period cost. That's going to equal our operating income, our income from operations, if you will. Then plus or minus non-operating income and expenses equals our net income. Now under absorption costing, when production exceeds sales, that means our ending inventory is going to increase, which has the effect of decreasing our cost of goods sold. If our cost of goods sold decreases, we're going to subtract less against revenue. Therefore, our gross margin is going to increase. Assuming there's no change in period cost, that means our operating income will increase. And assuming that there's no change in non-operating items, that means our net income will also increase. Now, under absorption costing, when production is less than sales, our ending inventory decreases, which means our cost of goods sold is going to increase. If our cost of goods sold increases against our revenue, that means our gross margin is going to decrease. Assuming no change in period cost, that means our operating income will decrease. Assuming no changes in our non-operating income or expenses, then our net income will decrease. Now we look at a similar slide for variable costing, again, utilizing the entire income statement of a manufacturing company. Under variable costing, when production exceeds sales, our inventory is going to increase. Therefore, under variable costing, that will cause our cost of goods sold to also increase, which will then cause a decrease in our gross margin. Assuming no change in period cost, that will cause a decrease in our operating income. Assuming no change in non-operating items, it will cause a decrease in net income. On the other hand, when production is less than sales under variable costing, the ending inventory is going to decrease, and in that case, that's going to actually decrease the cost of goods sold, which means we're going to have less to cost of goods sold to subtract from revenue, which means our gross income will increase. Assuming no changes in period cost, our operating income will increase. Assume no change in non-operating incomes, and that means our net income will also increase. Now let's take a look at several questions regarding absorption versus variable costing. Greenball Manufacturing has the following cost for the year. We have direct materials, we have direct labor, we have variable manufacturing overhead, fixed manufacturing overhead, fixed cost, fixed period cost, and variable costs, period costs. If Greenball uses variable costing, the value of the cost to be included as product cost for the year will be, again, stop the video, arrive at your choice, and when you're ready, restart your video. Okay, the answer here again, well, before we get to the answer, if Greenball uses variable costing, the value of cost to be included as product cost for the year will be, in this case, the answer is C, 800,000. And here's how we arrive at it. We're only going to include, under variable costing, we're only going to include our variable cost in our product costs. So we know direct materials are variable costs. We know direct labor are also variable cost, or is also variable cost, and our variable manufacturing overhead. So our variable product cost will be $800,000. Let's take a look at question number 2. Greenball Manufacturing has the following costs for the year. In this case, we're given prime costs of $700,000, variable manufacturing overhead of $100,000, fixed manufacturing overhead of $160,000, fixed period cost $30,000, and variable period cost $10,000. Now, if Greenball uses absorption costing, the value of the costing included as product cost for the year will be. Let's take a look at the answer to number 2. If Greenball uses absorption costing, the value of the cost to be included is product cost, in other words, those costs that will go into inventory, for the year will be, in this case, the answer is $960,000. And here's how we do the computation. First of all, we have to remember the term prime cost. Prime cost means costs that are directly attributable to making the product, and that includes direct materials and direct labor. So we know direct materials and direct labor are going to be basically product cost and variable product cost. So our prime cost, materials and labor, equals $700,000. Our variable manufacturing overhead, which is also included as part of our absorption costing, is $100,000. And our fixed manufacturing overhead is also included as part of absorption costing. That's $160,000. So the total cost under absorption costing would be $960,000. Question number 3, if a company prepares its financial reports using variable costing, and you're given 4 different choices, go ahead, stop the video, make your choice, and when you're ready, restart the video again. Okay, if a company prepares its financial reports under variable costing, and you're given the 4 choices, and the answer here is D, net income will decrease if production remains constant while sales increase. So if you take a look at A and B, we really don't have a definition of the relationship of sales to production, so we really can't predict much with A or B. In the case of C, production is less than sales, so that wouldn't be the case in this case. We have to find out when production exceeds sales. So in this case, net operating income will decrease if production remains constant while sales decrease. So in this case, what this means is when production exceeds sales. Okay, under those conditions, operating income is higher under absorption costing, which means that operating income is lower under variable costing. So in this case, net operating income will decrease if production remains constant while sales decrease. Let's take a look at number 4. Bass-Ackwards Inc. produces income statements based upon absorption and variable costing. The net income under variable costing was greater than that of absorption costing. This was most likely due, and you're given 4 choices. Go ahead and when you stop the video, determine your choice, and when you're ready for the answer, please restart your video. Okay, Bass-Ackwards produces income statements based upon absorption and variable costing. The net income under variable costing was greater than that of absorption costing. The most likely cause was C, sales volume exceeding production volume. Okay, if we take a look at the answers here, we take a look at A and D. And A and D is a change in variable period cost will affect variable and absorption cost in exactly the same way. If we take a look at B, it means production exceeded sales that result in operating income actually being higher under absorption and absorption costing. But if we take a look at C, where sales volume exceeds production volume, so this is when production is basically less than sales. In other words, sales volume is going to exceed production in this case. Operating income is higher under variable costing, and that's what we're saying here. The net income under variable costing was greater than that of absorption costing. So the correct answer in this case is C. Now let's take a look at the concept of what we call joint product costing. And joint product costing is where a product is it's a single input in terms of a product, let's say like crude oil, and at some point we're going to process it into other products, but it's impossible to really determine the costs as the products are being created jointly because they end up sharing the same costs. So in this case, we have an illustration, joint product cost of products A and B. Up to this point, there's $500,000 of joint costs. They both are assigned to both products A and B. We don't know how to split them off. Now what we need to do is when we get to a point where we do have to split these products off into separate products, we have to have a way of actually costing them into their individual products. Now, what I'm going to demonstrate here is the physical quantity method. And here at the split off point where product A and B become separate products, we see product A makes 800 units, or we make 800 units of product A from the joint product cost. So we make 200 units of product B from the joint product costs. So now we're going to use the physical quantity of the units produced to split the $500,000 worth of costs. So we take for product A, we take $500,000 of our joint cost, which are our total joint cost. We take the 800 units manufactured out of manufactured into product A, and we divide it by the total amount of units, which is the 800 units plus product B's 200 units, and those will add up to 1,000 units. So we divide the 800 units of product A by 1,000 units total, which means then when we do the allocation, 500,000 times basically 80% means we will allocate $400,000 of joint cost to product A. Do the same thing for product B, but in this case we're going to use 200 units, the 200 units of product B, divided by the 1,000 total units. That percentage, which is 20% times $500,000, means we will allocate $100,000 of joint cost to product B. Now that's utilizing joint product costing called the physical quantity method. Very simple, very straightforward. There's a couple other methods of joint product costing that you could run into. Okay, we can also use in joint product costing what we call the market-based method, and it's not that much more complicated than the physical unit method. The first thing we need to do is we need to, number one, calculate the total market value of products to be sold. Well, we know for product A we have 800 units, and we have determined that the selling price for those 800 units are going to be $4 per unit. So the total market value of this production batch to the split off point, its market value is worth $3,200. We do the same thing for product B. In this case, we take the 200 units and we know the product can be sold for $15 a unit. So we take 200 units times the $15 selling price and we come up with the market value of $3,000. So the total market value of product A and product B totals $6,200. Now what we're going to do is allocate the joint cost based upon the relative market value of these two products. So we take our $500,000 of joint cost and we divide it by the $3,200 market value, the percentage of that divided by 6,200. That means we're going to allocate $258,065 of joint cost to product A. We're going to do the same thing for product B, the $500,000 of joint cost. In this case, we're going to allocate it based upon the $3,000 market value divided by the total market value of 6,200. So that's going to come out to $241,935 of joint cost to be allocated to product B. So that's a market-based approach. We're going to try one other method of joint product costing. So let's consider this method of joint product costing. It's called the net realizable method. And what we need to do is, again, we come up with the relative market value of the products, and we can see here 800 units at $4 a unit, so we know what that relative market value is going to be. We also know 200 units at $15 per unit. We know what that relative market value is going to be. But what we do now is we also subtract out any cost associated with the product of additional processing. In the case of product A, what we find out is as we split the product off, product A will be subject to additional processing costs of $400. Product B is going to be subject to additional processing costs of $900. So now we take the 800 units from product A times our market sales price of $4 per unit. Then we subtract out the $400 of additional processing costs. That means our net realizable value is $2,800. We do this also then for product B. We take 200 units, the product B, times the market value of $15 selling price. To that quantity, then we subtract $900 of our additional processing cost, which means we have $2,100 of net realizable value. If we add both of those amounts together, we end up with $4,900 worth of net realizable value, and that's how we're going to do our allocation. $500,000 of joint cost times $2,800 net realizable value divided by the total net realizable value of $4,900. That percentage, then we come out to $285,714 of joint costs to be allocated to product A. Also, product B, we come up again $500,000 of joint costs, and our net realizable value is $2,100 for product V, divided by the $4,900. The total net realizable value leads us to allocate $214,286 to product B. Okay, now let's go to a multiple choice question regarding joint product costing. Garrison Wood Products produces 2 wood shelf products from the same design. Garrison Basic is a plain wood shelf, while Garrison Prime is a shelf that has been prepared for painting. The following is the data from these 2 products from last month. We show our Basic and our Prime. We show the number of units produced, if there's any additional cost to process, and the selling price per unit, and we also have the total joint production cost to come up with the Basic model and the Prime model together. So how much joint cost will be assigned to the Basic shelves using the physical units method? So again, compute your answer, stop your video, and when you're ready, restart your video. Okay, number 5 again. How much joint cost will be assigned to the Basic shelves using the physical units method? In this case, the answer is $28,000. And we take that by taking our 700 Basic units and dividing it by the total of 1,000 units produced of the shelves. So that's basically 70%. Times $40,000 equals $28,000 of joint costs that we're going to be allocating to Basic based upon the physical units method. Okay, let's try question number 6. Okay, question number 6. Garrison Wood Products produces 2 Basic wood shelf products. Again, we got the plain wood shelf, which is Garrison Basic, and we have the ready for painting, which is Garrison Prime. The following data comes from both the two, the production list here. And again, we're given the information, almost the same information from the previous slide. The question here is how much joint cost will be assigned to the prime shelves using the net realizable value method. So again, go ahead and stop your video. When you're ready, restart your video. Okay, number 6, how much joint cost will be assigned to the prime shelves using the net realizable value method? And the answer in this case is B, $15,652. And here's how we do the computation. In Basic, in terms of calculating net realizable value, we take the 700 units times the selling price of $40 per unit, and you'll notice there's no additional process to cost this. So the net realizable value for the Basic is $28,000. In the case of Prime, we have 300 units produced times our market value is $65 a unit, less the $5 per unit additional to process, which is right here, the $5 per unit, meaning that the net realizable value on the prime shelves is $18,000. So the total net realizable value of our Basic and Prime is $46,000. So in order to calculate the cost allocated to prime, we take the $18,000 net realizable value that we got from calculating prime, divided by the 46,000 total net realizable value, times the $40,000 joint production costs, and that equals $15,652 that is going to be allocated to prime. Now we're going to take a few minutes and go over job order costing and cost flow. Typically, we use job order costing when it's important to track costs by project or work order. Basically, product costs are accumulated by specific job, and we typically accumulate our product costs by materials, labor, and overhead. And again, overhead is our indirect costs of production. So what we're going to do is we're going to see how this works by T account journal entry and what we call job sheets. So job number one, and let's assume if people have a problem, if you have a problem trying to understand what a job order system is, think about taking your car into a car dealer. Now remember, a car dealer does a number of different things in their shop. They do everything from a simple adjustment or an oil change or a brake reline to an engine overhaul. So what they want to do is they want to be able to track the activity of the materials, labor, and overhead used on each job so they can charge the individual car owner for the correct procedures, parts, and so forth, because somebody who's getting an oil change does not want to be charged for parts and service that deal with major engine overhaul. So if that helps you think of it that way, and then of course when your costs are accumulated by your job, or you buy your work order, and then the work order is sent on to the cashier, and you end up paying based upon that work order when you're ready to take the car. So in this case, let's talk about, and this can be any type of job, individual jobs, you can call them widgets or whatever, but just let's assume that we have job one, and job one used $1,200 worth of materials. Direct labor used $2,000, and we had manufacturing overhead of $1,500, which was charged to the job. So again, we're going to take a look at inputs: direct materials, direct labor, and manufacturing overhead. That gets accumulated in work in process. So what we see here is the $1,200 of materials, the $2,000 of labor, and the $1,500 worth of overhead, and that is all charged as a debit to work in process. Now, I'm going to assume right now all these costs are offset by credits. Let's assume credits to cash because we're paying for them. Okay, now what we do is we post all those costs to the job cost sheet called job number one, which has materials of $1,200, labor of $2,000, and overhead of $1,500. So the total amount of products charged to job number one is $4,700. Now we're going to go on to job number two. Job number two, we use $50 of materials, $250 of labor, and $200 worth of overhead were charged to the job. So again, we're going to credit cash for the cost of those items, and we're going to debit work in process for the jobs in the job work in process of $50, the $250, and the $200. Now, if we total up our work in process at this point in time, it's $5,200. Now, with that in mind, in the back of your mind, we also have to post the individual details to job number two. That includes materials of $50, labor of $250, and overhead of $200 for a total of $500. So if we take job 1 and job 2, that represents the total amount of costs that have been charged to work in process. In this case, $5,200, which equals the total value of our jobs in work in process. So we see this total in work in process of $5,200, and we can see the individual details in the individual job sheets, job number 1 and job number 2. Okay, now let's look at the progression. Job number 1 was completed and the customer picked up the order. And then job number 2 was also completed. But let's take a look at job number 1 first. Okay, you can see all the entries I had to work in process originally. You can see everything there is grayed out, showing you it was from the previous job entry. I also have my entries to job number 1, the job sheets, job number 1 and job number 2, so I can track my job cost individually against my work in process. So job number 1 was completed and the customer picked up the order. So if job number 1 was completed, I have to move it from work in process to finished goods. And the question is, well, how much do I know? I have $5,200 in work in process. So how do I know how much to remove out of work in process to finished goods? Well, that's pretty easy because I have my job cost sheet and job 1 says the total is $4,700. So I'm going to make my entry and move $4,700 from work in process into finished goods. I also at the same time basically cancel out the job 1 sheet, so nothing else will be posted to it to say this job has been completed and it's in finished goods. So now you can see where I've transferred that amount from work in process to finished goods. Now I want to record where the customer picked up the order. In other words, they took it and basically we recorded the sale. So in that case, what we're going to do is we know that job cost was $4,700. So we're going to debit cost of goods sold for the $4,700 and finished goods for $4,700. Now, at the same time, by the same token, I didn't show this, but we would also have a sales number that would record receivables or a cash and a credit to sales that would offset the cost of goods sold. So with that, then the customer picked up the order and we recorded cost of goods sold. Okay, job number 2 is completed, so we're going to remove that out of work in process and move it into finished goods. So we debit finished goods for the amount of the job, $500, and we credit work in process for $500. Okay, now we no longer have any jobs in process, and you can see under work in process, the total amount of jobs in our general ledger account are equal to 0, since we have total debits and credits which equal each other. Also, if you take a look at the 2 job sheets that were canceled out, we have 0 work in process on those job sheets. Now you'll notice that we do have an amount in finished goods, and that is equal to $500 debit, which represents that job number 2 that's still under finished goods. Okay, now we're going to talk about job order costing, manufacturing overhead allocation. You'll remember from our previous job movements, we talked about direct material being charged to a job, direct labor, and then also we talked about overhead being charged to a job, or more accurately, overhead being allocated to a job. Now let's assume that we've incurred these overhead expenses. I'm paying cash for factory supervision, for insurance on factory, repair and maintenance, utilities, and other. These are all cash entries, so they're credits. The question is now, where do I debit that amount, those total amounts? And what happens is I'm going to debit them to an account called factory overhead. Factory overhead, you'll see, is kind of like a temporary holding account for our overhead charges. But right now I credit cash for the total $39,000, those individual amounts, and I debit factory overhead. Now with that then, I'm going to take my factory overhead that I have paid and I'm going to debit it to work in process, because remember, I have to allocate my factory overhead back into work in process, back into my jobs under, especially under full absorption type of costing. So I have to credit my factory overhead out and debit it to work in process. With that then, that's fine. So I have $39,000 of balance in my factory work or my work in process account now. Now the question becomes though is I got $39,000 and how do I get those individual overhead costs? How do I spare that $39,000 back to job one, assuming I have 3 jobs open, back to jobs 1, 2, and 3. Obviously, if this was an auto repair shop and job number 1 was simply an oil change and job number 3 was a major engine overhaul, the amount of overhead I should charge to job number 1 is probably going to be considerably less than the amount of overhead I should charge to job number 3. This is the normal acceptable way for allocating overhead. In order to do that, we have to allocate overhead based upon certain criteria that we establish as management of the company. It has to be on some form of rational basis, which provides an adequate amount of overhead being charged to the various jobs or operations within a company. Now we typically do that by some form of what we call overhead rate. In this case, we call this a predetermined overhead rate. And what we do in order to calculate that, we take the total amount of overhead that we estimate to be incurred for the coming accounting period. In other words, how much do we plan to spend in overhead for this coming year? Then we pick a cost driver, and the cost driver is a metric to be used to allocate the estimated overhead cost back to each particular job or each particular operation. So we have to select, we have to estimate the amount of overhead we're going to incur, and also what is the best cost driver to allocate that overhead back to our individual jobs or operations. Now, let's do this for an example. At the beginning of the year, ABC Company estimated it would incur $150,000 of factory overhead expenses. Now that's estimated again, remember. The company also determined overhead is best allocated to individual jobs based upon machine hours of production, and we estimate that we're going to incur 10,000 hours of 10,000 machine hours in the upcoming year. So we estimate we're going to have $150,000 worth of overhead, and we're going to use machine hours to allocate that overhead back to our individual jobs or operations. So under those conditions, we have to calculate the predetermined overhead rate. And the predetermined overhead rate is $150,000 of estimated manufacturing overhead divided by the 10,000 estimated machine hours. And again, I emphasize for both the numerator and the denominator, these are both estimates, they're not actual. Okay, but if we take the $150,000 estimated manufacturing overhead divided by the 10,000 estimated machine hours, that means our overhead rate is $15 per machine hour, 2 machine hours accumulated on individual jobs or individual operations. So every time a job incurs a machine hour, it's going to be charged as part of overhead allocation $15. If I incur 8 machine hours, that means I'm going to be charged there. That particular job is going to be charged with $120 worth of overhead allocation. Okay, now let's see how this process actually works. So during the year, the following was charged to. We're going to go through some different jobs here. Okay, job number 1 we charge $35,000 of materials to job number 1, $70,000 of labor, and 2,000 machine hours. So we know $35,000 worth of material, $70,000 worth of labor. In order to calculate the charge for overhead, we have to take 2,000 machine hours times the $15 per machine hour. That means $30,000 worth of overhead that we're going to be allocating to the job. Now notice I have my $35,000 of material, my $70,000 of overhead and work in process, and also $30,000 of overhead allocated to work in process. Notice also that since I directly pay for my materials and my labor, I'm going to assume right now materials and labor are paid in cash. So I debit my work in process for $35,000 and $70,000 in materials and labor, and I credit cash for $35,000 and $70,000. My overhead costs are a little bit different. Remember, my overhead costs are simply estimates of what I think my overhead's going to be. Remember, my estimated total overhead cost divided by my estimated total cost driver. So in this case, what I do is I debit work in process for the amount of the estimated overhead of 2,000 hours times $15. That's a debit of $30,000. But I'm going to credit it to this overhead, and I'll call it an overhead suspense account. In other words, it's going to accumulate my overhead cost between what I've allocated and my actual cost. In this case, the credit side accumulates the amount that's been allocated to my work in process. Okay, now job number 2, $20,000 of materials, $25,000 of labor, and 7,000 machine hours. In job number 2, then, if I want to calculate, here's my $20,000 of materials in the work in process with the credit to cash, $25,000 of labor to work in process with the credit to cash. Now, in order to calculate machine hours, I'm going to have to calculate the dollar value again. It'll be 7,000 machine hours times $15 an hour. So that's going to be $105,000. So I debit work in process for job number 2, $105,000, and I credit manufacturing overhead for $105,000. During the year, assuming that these were the only 2 jobs that I incurred during the year, so let's assume at the end of the year the company incurred $160,000 of actual manufacturing overhead. Now, I'm assuming that I'm paying for that overhead right now, just like I did with materials and labor. I'm paying for it in cash, $160,000. So what I'm going to do is my manufacturing overhead, I'm going to debit for $160,000, which represents the actual overhead that I've incurred, and I'm going to credit cash for the amount that I've actually spent. Now, if I take a look at my manufacturing overhead account, the left side, or the debit side, shows that I have manufacturing overhead that I've actually incurred, that I've really actually incurred $160,000. The amount of overhead that I've allocated, on the other hand, to my work in process, if I total that up, that's $135,000. So you can see there's a difference. And right here I have, again, so everybody can understand the balancing, you can see for job 1, materials, labor, and overhead, total $135,000. And also my job number 2, my materials, labor, and overhead for a total $150,000. And that adds to a total work in process of $285,000 here under work in process. Again, my manufacturing overhead shows $160,000 of actual cost, and I've applied $135,000, which means I did not apply enough overhead to my work in process. There's a technical term for this. When we don't apply enough overhead to work in process, we call that underapplied. And remember that term and remember the definition. That's extremely important. Okay, so in this case, if I didn't apply enough overhead, that means I have underapplied overhead. If the situation was reversed, and I had more overhead, I applied more overhead than I actually incurred, I would have over applied overhead. So in this case, you can see the difference between the two, 160 versus 35. Okay, manufacturing overhead is like any other expense type of account or suspense account. It has to be zeroed out at the end of the year. So I have to make the difference go away. Now, the way I do that is the manufacturing overhead account must be closed out at the end of the accounting period. Now, if the variance is not material, in other words, the difference between the debit side and the credit side, the difference is not material, I'll simply close it out to work in process or close it out to cost of goods sold. And here's an example. In this case, I'm going to take the difference and I'm going to flush out the difference. I'm going to debit cost of goods sold for the cost of the manufacturing overhead, the underapplied overhead, and I'm going to credit that to my manufacturing overhead account. And you can see now that both my debits and credits in manufacturing overhead equal each other. So in effect, I've effectively zeroed out the manufacturing overhead account by transferring that additional $25,000 to cost of goods sold. So if the variance or this difference is not material to the financial statements, I'll just simply want to close the difference out from manufacturing overhead to cost of goods sold. However, there could be situations where the difference, in effect, the variance is material. It's a large amount in the financial statements. If that's the case, I need to allocate that difference back to my work in process, to my finished goods, and cost of goods sold based upon the relative values of each account. Now, it's important to note debit balances in the manufacturing overhead account are from actual overhead expenses, the $160,000 I was talking about. Credit entries in the account are from allocated overhead expenditures, and that was $135,000. Okay, before the closing entry, so assume we're right at the point where we have a debit and manufacturing overhead of $160,000, total credits of $135,000. Before the closing entry, if the manufacturing overhead account has a debit balance, in this case, which it does, overhead is said to be under-absorbed, or another word for it is under-applied. Either term can be used in the CPA exam. In other words, we had more overhead than we actually absorbed into work in process. Okay, before the closing entry, if the manufacturing overhead account has a credit balance, in other words, we applied too much overhead to work in process than we actually had, okay, the overhead is said to be over-absorbed or over-applied. Again, you have to know both of those terms.